Okay. So in today's class, we want to look at change in accounting estimates, as well as prior period errors. All right, they're not difficult aspects, but of course, it's something that is very much examinable. All right, so let's quickly look into it now, to have better understanding of what's going on there. All right. So in terms of changing accounting estimates, all right, we're looking at it now from the angle that many items, all right, can only be estimated due to inherent uncertainties in businesses. All right, let's take for example now. We can agree now that in most cases when we are preparing the financials, we do lots of estimates. All right, like for example, in regards to the useful life of an asset. All right, you find that one company estimates the useful life of their asset. Let's say, for example, a machinery. One company can have a useful life for 5 years on a machinery. The next company, all right, with similar type of machinery, they could be having a useful life of maybe 6 years. Right. So in regards to this, it is because now the standard does not specify um, the exact useful life in regards to our asset, but it just says no, you should depreciate an asset based on the expected consumption pattern in regards to that asset. So hence you find that we have different companies applying different useful life in terms of the assets. The same applies on depreciation. You find that one company could be applying reducing balance method on a machinery. The other company could be applying straight line method or the units of production method with regards to depreciation of machinery. So we call those now estimates. All right. So in today's class, we want to look at cases whereby now a company now revise its estimate. So in other words, they say, no, the residual value of our asset was 10,000, all right? But maybe 2 years or 3 years later, they then revise to say, no, the residual value of our asset is now 15,000. So in regards to this, we call those changes in accounting estimates. All right, there is no problem with doing that. IFRS does allow us to do the change in accounting estimates. All right. So in regards to this, let's quickly look into it now to see what's going on. So estimation involves judgment based on the latest or reliable information. So when a company does estimates, it is mostly based on the latest reliable available information. So examples of estimates, all right, is what we call provision for bad debts, all right. With regards to going to be looking at financial instruments, all right, where we do the estimation, all right, the companies, they calculate what we call allowance for credit losses. So in regards to this is based on the sense to say, how much do we anticipate not to recover from the debtors? All right. So in regards to this, we call that a provision for bad debt. So companies do an estimation in regards to that. All right. Then we have inventory obsolescence. All right. Please note, inventory obsolescence is different to inventory accounting policy, where we did the fee for the weighted average and all that. All right. Inventory obsolescence is whereby you're calculating impairment of your inventory. So you're saying, no, take for example, in terms of technology. All right. So you'll find that, say, for example, you're in the telecommunications industry. All right. And then now people no longer prefer your type of technology. Like, for instance, BBM. All right. Remember BlackBerry phones? They used to have what we call BBN back then. And now, when they introduced WhatsApp, all right, BBM was a thing of the past. People now prefer to use WhatsApp, Facebook, and all those kind of things. And then BBM became a thing of the past. So in that case, that's what we can call obsolescence. All right. So in that case, that's an estimation of impairment. All right. So in regards to this, we're saying no, a change. In regards to this, we call that a change in accounting estimates. All right. Then we have fair value of financial assets or liabilities. All right. In regards to this, of course, it's a change in accounting estimate. And then we have useful lives or expected consumption patterns of PPE. Right, so here, when we talk about useful life, expected consumption pattern of PPE, we are looking at things like depreciation, residual value, useful life. Right, so changes of any one of those factors, it is actually a change in accounting estimate. All right, let me just quickly write that down so that we'll be in position to know what's going on there. So change in accounting estimates. All right, so examples, all right, or scenarios that give rise to change in accounting estimates. All right, so we're looking at change in residual value. All right, change in residual value of an asset, right? Then we have change in depreciation method. All right, this one is very common. Actually, these three: change in residual value, change in depreciation, change in useful life of an asset. All right, so they tell you that remaining useful life of an asset has changed. All right, so in this case, we call this change in accounting estimate, change in provision for warranty or bad debts. All right, we call this the change in accounting estimates. All right, so we now have to have an understanding now. All right, what happens now? What gives rise to the change in accounting estimates? Remember, they can ask us to discuss. All right, with regards to change in accounting estimate, like what they did with change in accounting policy based on the previous class. All right, so a change in estimates arise from new information being available, not errors. So it's good to note the change in estimate is not an error, all right, but just additional information came to effect. All right, so accounting for change, a change in accounting estimate is recognized prospectively in profit and loss. All right, so what does it mean when you say prospectively? So prospectively, it means now the change is accounted from the current year going forward. All right, it's different, remember, with regards to change in accounting policy, where we had to do retrospective adjustment. We had to open the previous years. All right, but now with change in accounting estimates, it's done prospectively. All right, it means now we account for it from the current year going forward. So a change in accounting estimates is accounted for prospectively. All right. So in this case, we adjust current year financials and following years financials. All right. No effect on prior years. Let's use previous years. Right? So there's no effect on the previous years. You do not need to adjust the previous years, right? You only account for it from the current year going forward. So that's what we have in regards to the change in the accounting estimate. All right. So that's what we have in regards to this part. All right. Good part there. All right. And then let's proceed now to see what's going on. The period of the um, the period of the change, if it affects only current period, all right, and then the period of the change and the future period, if it affects both. So in terms of this, so they're just telling us now that the change in accounting estimate, all right, we account for it during these periods, all right. So that's what we account for, all right. And then exception, all right. In regards to this, all right, we have an accounting estimate that gives rise to changes in assets, liabilities, or equity is recognized by adjusting the carrying amount in the period of the change. All right. So in regards to this, so we are going to find out now that we have things like financial instruments. All right. So in regards to the financial or even leases, yeah, a very good example is leases. All right. So on leases now we can change the lease term. All right. So in regards to this, or even the future value, all right, the guaranteed or unguaranteed residual value could be changed, or the implicit interest rate could be changed. Now, if that change, we can agree now, it actually affects the right of use of asset if we are looking at it in the sense of the lessee. So now the standard is saying that change will be accounted, all right, only in the period of the change. So it adjusts the right of you adjust the right of use only in the current period of the change. All right, but I'll try to look for an example where there's a reassessment of um, the implicit interest rate or reassessment of the lease term or something like that. All right. And then in terms of the disclosure, what are we expected to disclose with regards to change in accounting estimates? So expected to disclose the nature and amount of the change in the accounting estimates. All right. So in the current and future periods, unless if it's impractical. So impractical, it means you're not in position to determine the future estimation. All right. And if the amount of the effect in future period is not disclosed because estimating it is impractical, you have to disclose that fact. All right. So just in a small example with regards to the change in accounting estimate. So this is the note that you disclose. So you just say during the year, the residual value was changed. So this is the nature, all right, in regards to this. And then this change in estimate resulting in an increase in depreciation in the current year of 1,200. The cumulative effect of this change on future periods will be an increase in depreciation of 1,800. So literally, that's what we have now is forming part of the change in accounting estimate. All right, let's quickly look into it. All right, let's look at a small example in regards to the change in accounting estimate and see how far we can go. All right, so this is the question that I gave you guys some time ago. I'm sure you guys still remember in regards to this. All right, let's see now. All right, to see what's happening there. All right. So, the accounting profit before tax of True Blue Limited for the year ended 20 February 2011 was 600,000 and 500,000 for the financial year ended 20 February 2010. The following information relating to True Blue is presented to you for the period ending 20 February 2011. Inventory amounting to 95,000 was destroyed and written off due to flood during the year. An amount of 60,000 was received from the insurance company's compensation for the inventory that was destroyed. The two amounts are included in the accounting profit before tax for the year ended 20 February 2011. Assume that these amounts are material. The directors of the company decided to change the accounting policy in respect to the valuation of the inventory, since the new policy will ensure a more reliable value of inventory. Previously, inventory was valued according to the weighted average method, but it should now be valued according to the first in, first out method. This change in accounting policy has not been accounted for as yet. The value of inventory on 20th February, based on the two methods of valuation, was as follows. Of course, this one we did, we said it was a change in accounting policy. All right. And then during the current year, the bookkeeper established that a material error, all right, had been made in the published financial statements for the year ended 20th February 2010. New manufacturing equipment amounting to 25,000 that was acquired on 1st of September 29 was incorrectly recorded as administrative expenses. The company depreciates such equipment at 20% per annum, according to the straight line method, apportioned for part of a year. This error has not been corrected. The accountant immediately informed the SARS of the error, and the SARS agreed to reopen the 2010 assessment in order to correct this error. In accordance with the Income Tax Act, the SARS granted Section 12C allowance on equipment at 40% in the first year and 20% second year, third and fourth years, which is not apportioned for part of a year. True Blue Limited acquired a fleet of delivery vehicles on 1st of March 2019 for 500,000. The fleet has been depreciated over 3 years over the straight line method, apportioned for part of a year. The fleet has a residual value of 140,000. The depreciation for the year ended 20 February 2011 was correctly recorded. On 20 February 2011, after depreciation was recorded, management extended maintenance contract of the fleet to 20 February 2013 and estimated the remaining useful life of the fleet on 20 February 2011 to 2 years. This change has not been accounted for as yet. Right, let's look into it. So we have a fleet of delivery vehicles. all right, which they're saying, no, we're going to be depreciating them over a period of 3 years, all right? So this is from 1st of March, 29, all right? And then, so in regards to this, all right, we've been told now that on 20th February 2011, all right, look at it. The remaining useful life of the fleet on 20th February 2011, all right, this is now 2 years. This is not right. We can agree that this is a change in accounting estimate. It was supposed to be how much? We can agree on 20th February, on 20th February 2011, the remaining useful life based on original information was supposed to be, so we use it for 2010 and 2011, which means we use it for 2 years. So the remaining useful life was supposed to be 1 year. But however, now they're telling us now that no, in regards to this information, right, the remaining useful life is now 2 years. So that's a very good example of a change in accounting estimate. Right. The SR revenue grants a Section 11E warranty allowance on the cost of the fleet of delivery vehicles over 4 years, which is apportioned for part of a year. The income tax rate is 28% and was not adjusted for the past 5 years. There are no temporal difference other than those that are apparent from the question. The deferred tax liability on 20 February 29 was 3.5. All the temporal differences included in the deferred tax balance of 3,500,000 are subject to tax rate of 28% with no capital gains tax implications. Retained earnings balance on 1st of March 29 was 800. The company had 500,000 issued ordinary shares since incorporation. Right, let's account for the change in accounting estimates. All right, so in regards to this, so change in accounting estimate not. All right, so sometimes they can ask us to prepare the change in accounting estimate not. All right, so the first thing that you need to write, of course, is this scenario of the events that took place. But before we do that, let's do the workings. All right, so in terms of this, right, on 20th February 2011, all right, the remaining useful life of the fleet, all right, should have been, so in terms of this, we see the total useful life of the fleet we told has been 3 years, all right, on 1st of March 2011. So which means now, all right, so 3 years, all right, it should be 3 years minus the period that lapsed from 1st of March 29 until 20th February 2011. So there's 2 years, there's full 2 years there. So the remaining useful life should have been 3 minus 2, all right, which is total useful life. So in regards to this, it gives us 1 year. All right. So total useful life, all right, was estimated at 3 years on 1st of March 29. All right. And then now, which means now utilized period from 1st of March 29 to 20th Feb 2011. We can agree there's full 2 years there. All right. There's 2 years. Right? So which means the remaining useful life now is sitting at 1 year. So the remaining useful life is supposed to sit at 1 year. However, right, in regards to this, however, of course, in the exam, you don't need to write this, all right? I'm just trying to explain to you guys how we come up with the change in the estimate. However, at 20th February 2011, all right, it was estimated that remaining life is, so look at it. So here they estimated now, all right, on 20th February 2011, they said, no, the remaining useful life is now 2 years. All right, so do you see? Now, there is a difference, all right, in regards to the original estimated useful life and the new estimate. All right, so what do we do? All right, what do we do now? All right, so in this case, we need to calculate depreciation. All right, based on new estimated useful life. All right. So you need to calculate depreciation on the new estimated useful life. All right. And then we also need, all right, we also need to calculate depreciation on the old estimated useful life. All right. So you need to do both depreciation. All right. So let's calculate now. So depreciation on new estimated useful life. All right. You calculate by taking. So you're going to need carrying amount at the beginning of the year. All right. So you're going to need the carrying amount of our asset at the beginning of the year. Then you divide that by remaining useful life at beginning of the year, not at year end, right? But at beginning. Please, the keyword is the remaining useful life at the beginning of the year. And that's going to be carrying amount minus residual value, of course. All right, that's how we calculate depreciation. All right, and then so that's how we go about it in regards to that calculation. Right, just something to note. All right, in regards to our classes. Oh, what did I do? All right, I'm glad that you guys are attending classes. All right. Let me just share with you some of the encounters that I experienced with the other students. All right. So you see the things that we do in class. These are the kind of stuff those guys examine you. All right. This is actually the kind of stuff that they examine you out there in the corporate. So now what happens now is if you don't know, let's say for example, you don't know how to calculate depreciation. It's so weird, all right? But your fellow colleagues now, you'll be shy to consult with them because it's general knowledge, all right? So, um, the point I'm trying to raise is do not just think of it to say, no, I'm just going to do this and pass and forget about it. But if you're thinking of staying in the accounting environment, you need all these concepts. So please know these things, right? Sometimes I'm not saying I complain, right? But sometimes I do come across my students will be like, can you please help me? How do I do the PPE? Not again. I've been tasked to do that at work and then I forgot and all that. Not to say I'm complaining. And then so I'll be like, oh, why can't you ask your colleagues? They're like, no, it's embarrassing to ask that. Everybody knows the PPE note and all that, right? So please, guys, never think that these things are just going to end here, right? If you're in the accounting environment, you're going to be utilizing all these things that we do. So if you can also encourage your friends, right? And of course, there's some guys who don't do feel like no, again, we just need to pass and then we forget about the module. These things will come to haunt you again in the corporate, right? Especially if you're working for a well-organized company, you actually feel the pressure, right? So anyways, back to our content. So we're saying no, the depreciation, we're going to need the new estimated useful life, right? So we need the carrying amount at beginning of year minus residual value, and then we divide by remaining useful life at beginning of current year. All right. So let's quickly look into it. All right. So what is the carrying amount at beginning of the year? All right, that's what we want to assess. So here we're given the cost of the fleet is 500,000 on 1st of March, right? The cost of the fleet is sitting at 500,000, right? So cost of the fleet, right? So this is 1st of March, the date of acquisition, 2009. The cost of the fleet is sitting at 500,000, all right? Less. So we then have to less accumulated depreciation, all right? So accumulated depreciation for which period? From 1st of March, 2009 until 20th Feb, all right? So accumulated depreciation, so accumulated depreciation from 1st of March 2009 until 20th Feb 2010. All right. So this is what we have as our accumulated depreciation. So remember one carrying amount at the beginning of the year. All right, well, that's what we want to do. So which means now to determine carrying amount at the beginning of the year. All right. So we need carrying amount at 1st of March 2010. That is the beginning of the current year of the change. Right, so we saw the asset as a value of 500,000, then we minus the residual value. So how much is the residual value for asset? It's sitting in it, the residual value of 140,000. So minus 140,000, right? And then we divide by useful life. What is the useful life? The original. So if you look at it, this is the original useful life, right? Before the change in estimate. All right. Remember, we said the change in estimate will account for it prospectively. So it happens from the current year going forward. So we need, in regards to this, we divide with the original estimate. So we 500 minus 114 divided by 3, all right? Then it gives us 120. So it means now 120 is the depreciation which they recognize in the previous years. All right, so the depreciation is this. That means now carrying amount at beginning of year, all right, is sitting at 380, which means now new depreciation, all right? That's what we want to calculate. So new depreciation is going to be this new carrying amount of 380 minus, all right? So if there was a change in estimate with regards to residual value, we're going to say minus the new residual value, all right? If there was a change in estimate with regards to depreciation method, of course, we're going to account for it based on that as well. So here we have residual value of 140 did not change, so minus 140. All right, now here is where many students get confused. Now, what is the remaining useful life of our asset at the beginning of 1st of January, 1st of March 2010? Right? What is the remaining useful life? Now we can agree now, right? Let's look into it. So remaining useful life on 31 March 2011 is 3 years. It's 2 years. All right. So what is the remaining useful life? At beginning of 1st of, so not 31 March, but 20th February. Right? So what is the remaining useful life at 1st of March 2010? Now, do you guys agree with me now? Let's say, for example, at 31 December, right? At 31 December, let's say your birthday is on 31 December, all right? So on 31 December, you turned, maybe let's say you turned 25, 31 December. Now, what was your age on 1st of January? Do you agree with me to be 25 minus 1? That was your age, right? So that's the age that you have. The same applies with assets, all right? So if you take your assets, you say, no, my car, right, on 31 December, my car is an age of 4 years. So it has a remaining life of 4 years. I'm going to use my car for the next 4 years. That is on 31 December 2024. You said, no, my car, I'm going to use it for 4 years. So on 1st of January 2024, how long were you planning to use your car? We can agree to be 4 plus 1. That makes it 5. So that's the same principle in regards to this. All right. It means now, since they told us the remaining useful life is 2 years at the end of the year. So which means now the remaining useful life at the beginning of the year, we add 1 to make it 3. I hope that principle is making sense because I know for a fact that many students always get confused in regards to that. All right. Any questions or anyone who's lost in regards to that principle? No one. Right. So basically that's how we go about it in regards to this part. Right. So we have it there. And then old depreciation. Let's look into it. So old depreciation, all right, to do the calculation. So the old depreciation, there's nothing new or nothing hectic. We're going to calculate it on the normal way. So we're going to take it by taking. So we take, of course, it's going to be 380 divided by 140, all right? Then we divide it by, so the 380 minus 140. Oh, sorry, it's 500, not 380, sorry. All right, remember it's based on the original information, All right. So the whole depreciation, no changes. They're using straight line method. So you're just going to take the original cost. So they calculate by taking the original cost minus residual value, then they divide it by the 3. So it's based on the original information that we had there. All right. So it'll be 500,000 minus 114 divided by 3. All right. So it takes them to 120,000. So all depreciation is based on initial information before the change. Now, what is the effect of the change? All right, you see, in terms of this, the effect of the change is increase in depreciation. As you guys can see, there's increase in depreciation of, so it's actually decrease. All right, there's a decrease in depreciation, all right, from 120 to 180. All right, decrease in depreciation from, right, so in regards to this, there's a decrease in depreciation of 40,000. Right. So that's what you have on your calculation. Then you present it on your note. So what do you have on the note? Right. So you're going to present it like this now. So you're going to say during the year. All right. So you summarize the information that they gave us. All right. So this is the note. So what do you have on your note? So you then have to write down. All right. Also in regards to this now. So management extended the maintenance contract. All right. So you write down during the year, management extended. All right, remember we said with regards to the note, you're supposed to state the nature. So management extended, all right, what did management extend? So they extended the maintenance. Management extended the maintenance of the, so management extended the maintenance contract of the fleet. Maintenance contract of the fleet, all right? So the maintenance of the fleet to 20th February 2013, all right? To 20th February 2013. So you are stating the nature, all right? Just like what we have on our notes here. If you look at it, all right, we stated the nature, all right? Then after that, all right, you now have to state this this change, all right? The change in estimate resulted in, right? What is the effect in the result of the change in estimate? So it resulted now in decrease in depreciation. All right, so you say no, it resulted in decrease in depreciation of 40,000. All right, you saw that you did work it out down there that your decrease in depreciation is going to be 40,000, resulting in decrease in depreciation of 40,000. All right. So this is what you have in regards to this. You said no, it resulted, yeah, there was increase in depreciation. All right. So, but on that one, you just said there is a decrease in depreciation there. All right. And then, of course, after that, all right, and then what is the effect of the change in the future? All right. So you then said in the future, there will be a decrease in depreciation too. So in regards to this, the new depreciation now, which is going to be 80,000. So that's what we have in terms of the change in accounting estimate. It's not really a difficult one, but basically that's what you have there. All right. And then, of course, you then, if they want you to prepare the financials, all right. So if they give you the profit, all right, let me just show you if they said prepare the statement of profit and loss, all right. So in statement of profit and loss, all right, so if, say, for example, they say calculate the adjusted profit. So you have your unadjusted profit, all right? So in regards to this, you have an unadjusted profit, which they gave us in the information there. We have a profit they gave us at 600,000, all right? So we have 600,000 as our unadjusted profit. But then we have change in depreciation, all right? Remember now, in regards to this profit, includes the old depreciation. All right. So that is the 120. They originally deducted the 120. So you have two choices. You can either reverse the 120, then you deduct the correct depreciation. Let's just use that method. All right. So old depreciation, it was accounted for, right, when they calculated the profit. So we're going to add it, all right, by reverse. Then new depreciation, all right. That's the one that we need to deduct there. All right. So we have 80,000 there, which means now corrected profit. So the corrected profit now will be sitting in like this. So that is the effect now of the change in accounting estimate on the statement of profit and loss. All right. Any questions for me, guys, before we proceed? No questions. Right. Cool. Others questions? Nothing. Right. That's basically what we have, right? Of course, we're gonna look at one or two other examples, right, in regards to these changes where we look at maybe comprehensive examples there. Right, but that's what we have in regards to change in accounting estimate. Now let's look at prior period errors, right? We have oh, please explain years again. So I assume you mean the remaining useful life, right? Think about it, all right? You have your phone, all right? Let's give an example of a phone. I believe everyone has a phone now, all right? Now, um, if you're using your phone, all right, you bought your phone. Let's say you bought your phone last year, all right? You bought your phone last year, regardless of which brand you have in terms of your phone. But you say you plan to use your phone for 3 years. Right? You bought it last year, right? 1st of January 2024, you bought your phone. You plan to use that phone for 3 years. So it means now the useful life of your phone is 3 years, all right? And then at the end of at the end of 2024, which is year one, all right, you then reassessed. You said, no, 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 no. I think this phone is very strong. All right, I'm going to use it. I think the remaining life of my phone is now 4 years. Okay, let's say at the end of 2025, this year. So I said, no, my phone is very strong. I'm planning to use this phone for the next 4 years. Let me just give it as an example. Let's write down. All right. So you have a phone, you bought a phone. Um, bought a phone, all right, for 50,000, 20,000. All right, you bought a phone for 20,000, maybe it's an iPhone or something like that. All right, and then on 1st of January 2024, all right, you plan to use the phone for 5 years. For 5 years, right? You plan to use a phone for 5 years. Now, it's 31 December 2025. All right, you realized that the phone is very strong. All right, you realize the phone is very strong, right? And that you actually want to use your phone for the next, maybe for the next 6 years, or maybe, yeah, let's say 6 years, right? You're actually saying, no, I'm going to use this phone for the next 6 years. Now, what is the remaining useful life of the phone on 1st of January 2025? Now, we can agree now that as in terms of this, all right, If you plan to use the phone for the next 6 years on 31 December 2025, do you agree with me now that your phone is left on 1st of January 2025? Your phone is left with 7 years. So, in other words, what we are saying now is remember now, so from 2025, all right, so you have 26, 27, 28, 29, 30, 31. So, you plan to use your phone, you plan to replace the phone on 1 December 20, 31. That's the next 6 years. So, how many years are there left on 1st of January 2025? So it means now you can count. So it's either you add one to make it six, or you can count now from 1st of Jan 2025 until 31 December 2020, 2031. So which you equal to 6 years. Or alternative, you can just say, remember you have 5 at the end of the year where you did the estimate, then you can just add 1 to make it 6. Right, I don't know if it's clear now in regards to this example. Miss Eza, is it fine now?
Yes, clear. Thank you.
All right, good. But I just watch out. It's not only you, but please look at that aspect, guys, because they love bringing it up. All right, let's move on to the next one. All right. So the next one now is I want to look at prior period errors. All right. So annual financials do not comply with IFRS if they have, right, material errors. Immaterial errors made intentionally to achieve a particular presentation of the financial position, financial performance, or cash flow, which we can call fraud, of course. Or error implies that the company did something wrong, right? So not making sufficient effort to obtain information or applying the information incorrectly. All right. So these are the scenarios that we have now with regards to prior period errors. So we're saying no, the financial statements that we've been presented with in the previous years, they're sitting in now with errors. All right, so we have different types of errors that we can have on the financials. All right, so errors arise from incorrect recognition, measurement, presentation, and disclosure of elements. All right, so the examples of errors, we have errors of omissions, all right, which we can call errors of omission. Maybe you did include something, right? Completely, you're misstated, all right? You did not record the amount. We have misstatements. So misstatements, probably you recorded an amount incorrectly. You're 10,000, then you recorded it as 1 million, somewhere along those lines. Or failure to use or misuse reliable information. All right, so in regards to this, you did not apply reliable information correctly. All right, or mathematical mistakes, additions, subtractions, multiplication, division, and all those kind of things. Erroneous application of accounting policies. All right, so in regards to this, where company is applying a different policy, you used it another one, right, which is incorrect, or oversights, or misinterpretation of facts, or fraud. So these are the very common types of errors that we have on the financial statements. All right, so because of weaknesses in the controls of the company, as well as human errors, right, the financials will be prone or subject to these types of errors there. All right, so now I want to understand what will be the effect, all right, if you realize that the financials are subject to error. So unfortunately now with errors, guys, sometimes the error is discovered at a later period. All right, it's not discovered in the period of the error. It could be maybe 2 years later, all right, or a year later, all right, whereby maybe the auditors, so the current auditors may not detect the error, then the new auditors are the ones who discover the error. So let's see now what will be the implication. So if an error is discovered in current period, there's no problem. All right, so if you maybe it's the auditors or the accountants that discover the current error, there's no problem. All you just have to do is just to amend the financials and then you move on. All right, so say maybe the recorded sales is 10,000 instead of 100,000. All right, you just say, no, amend the financials. So in this case, record the revenue amount to 100,000. No issues. Remember, the financials are not yet published. You just correct it. All right. Now, if the error is discovered in current period but relating to previous period, that's where we have issues. All right. So in that case now, if the error now is from the previous years, we do what we do retrospective adjustments in comparative information in current period. So we do retrospective application, just like what we did with with change in accounting policies. All right, so that's what we have there. So correct material prior period errors retrospectively in the first set of financial statements authorized for issue after their discovery, right, by restating the comparative amounts for the prior periods presented in which the error occurred. If the error occurred before the earliest prior period presented, restating the opening balance of assets, liabilities, and equity for the earliest prior period presented. So in terms of this, all right, that's how we account for it. And then limitation of retrospective restatement. If it is impractical to determine the prior period effect of material error, then the opening balance of assets, liabilities, and equity must be adjusted for the earliest period for which retrospective restatement is practical, which may be the current period. So literally in regards to this, what it means now is sometimes it's impractical. We don't have the old information. All right, let's take, for example, we lost, all right, especially back in the days where companies used to keep hard copies, all right? Maybe they lost the old information. So in those circumstances, it becomes impractical to actually adjust the old financial statement. So what we do in those circumstances means now we just need to amend the opening balances for the current year, all right? Then we account for it just for this year, all right? And then if it is practical to determine the cumulative effect at the beginning of the current period, then comparative information must be restated to correct the error prospectively from the earliest date practical. So simply in regards to this, it just means now if we're not in position to also adjust the opening balances, right? It just simply means now we do account for the error from the current year going forward. So prospectively will be from now going forward. All right, that's what we have. And then the disclosure, all right, in regards to the error, all right, we are required to disclose the nature of the prior period errors, all right, that is what happened, all right. In regards to this, you're just summarizing the events that gave rise to the error there. If the bookkeeper, probably the bookkeeper incorrectly debited, all right, the bookkeeper incorrectly debited liabilities instead of crediting them. So in that case, that's an error. You just write that down, all right? And then the amount of the adjustment for each period presented were practical, all right? So in regards to this, we're looking at it in the sense that just like what we did with changing accounting policy, all right, you need to account for it to say what is the effect of the error in statement of financial position, as well as what is the effect of the error in statement of profit and loss. All right, that's what we have. And then if retrospective restatement is impractical, disclose the circumstances that led to that condition and a description of how and from when the error has been corrected. Let's look at this simple example, in regards to the note for prior period errors. So electricity was underpaid during 2005. So that's the nature. The resulting outstanding electricity payment was made during 2006, after which the comparative amounts have been appropriately restated. The effect of the adjustment on the 2005 result is as follows. So here you have increase in other expenses, decrease in income tax, then decrease in profit. And then you have increase in electricity payable. So this is now in the statement of financial position, right? And then you have decrease in current tax payable. Then you have a decrease in equity. All right. So basically, of course, you guys don't do earnings per share. All right. You're not required to know much about earnings per share. No longer doing IAS 33. So you don't worry about the diluted earnings and the basic earnings per share. All right. That's how we account for it. Let's look at this simple example, all right, to have an understanding. So if you note, right, in terms of this point 3, all right, we've been told during the current year, the bookkeeper established, all right, that a material error had been made in the published financial statements for the year ended 20 February 2010. New manufacturing equipment amounting to 25,000 that was acquired on 1st of September 29 was incorrectly recorded as administrative expenses. The company depreciates such equipment at 20% per annum, according to the straight line method. But let's look at what happened. You see, so new manufacturing equipment of 25,000 that was acquired on 1st of March 29 was incorrectly recorded. Do you see? They incorrectly recorded it as administrative expenses. That's where our error is. So equipment was accounted for as administrative expenses. All right. Now, let's look at it. All right. And see now, when is this error happening? Do you see? So the error happened now during the 2010 financial year. All right, that's where the error took place. So 2010 financial year, and now we're presenting the information in which year? We're presenting the information in 2011. All right, so basically now, in terms of this, so we have prior period error. All right, you write down prior period error. Then you give the description of the nature of the error. All right, so in regards to this, let's quickly look at it. All right, so during the current year, you write that down, summarize. So during the current year, all right, the bookkeeper established, the bookkeeper established that, what did the bookkeeper establish? So they established that a material error had been made in published financial statements. Has been made in the published financial statements. All right. So material error has been made in the published financial statements for the year ended 20 February 2010. 20th February 2010. All right. So we have it sitting there. All right. And then, of course, you need to start the type of error. So new manufacturing equipment. All right. So you write down new manufacturing equipment costing 25,000. Right. Was incorrectly recorded as administrative expenses. All right. It was incorrectly recorded as administrative expenses. The effect of the error has been adjusted for retrospectively as follows. All right. Now you then tell them, how did you adjust the effect of the error? So you look at it in the statement of profit and loss. All right. What is the effect of this error? So you have your years now. You have 2011, 2010, and 29. All right. So you present your information 2011, 2010, and 2009. So that's what you have. So the error now, it occurred in which year? All right. In regards to this. So if you look at it, all right, in 2009, that's where the error occurred, right? That's the period of the error. So it means now, right, in 2011, so in 2009, I mean, you're going to decrease. Do you see? There's a decrease in administrative expense in 2011. And 29, I mean, they recorded too much. Oh, actually, it's 2010, right? So you have 2010 and 2011. So you have a decrease in administrative expense. Administrative expenses. So you're saying, no, the administrative expenses that you recorded, all right, there's 25,000. Want to decrease it. All right, that's the effect on the statement of profit and loss. And then what else do you have? Now, you did not account for depreciation in 2011. So you're supposed to account for depreciation in 2011. So it means now you then also have increase in depreciation. Right? So you have increase in depreciation. How was your depreciation supposed to be? Remember now, you are supposed to depreciate this equipment at 20% times. So you have 20% times what? So in terms of this, do you see they're depreciating 20% according to straight line method? When was the asset bought? Do you see 1st of September 29. So you have September, October, November, December, January, February. So that's 6 months. So times 6 out of 12. All right. So this is the depreciation you should have accounted for in 2010. So you have 25,000 times 20% times 6 out of 12. All right, it gives you 2,500. Then depreciation for 2011, all right, you have increase in depreciation also in 2011, which in this case you had your asset for the whole year. So your depreciation is just going to be 25,000 times 20%. So it takes you to there. All right, so that's what you have as your adjustments there. All right. And then in terms of this, you have what? You're going to sitting now with, you have increase in, so you have increase, so the increase you record it in brackets, right, to say there's an increase, and then you have a decrease, you record it as a positive in expenses. All right, so in terms of this, your expenses here are increasing by 5,000, and then here your expenses are decreasing by the difference between these two, 22,000. And then what is the effect of this on the statement of in the income tax? So if you increase your expense, we can agree now the income tax goes down. So you have a decrease, all right, or increase in income tax. Right, so how are you going to account for that? So you have 5,000 times 20%, all right? And then we have the next one is 22,500 times 20%. All right, so that's what you have. So you have 5,000 times 20%, and then you have 22,500 times 20%. Right, then you calculate your net effect there. So this one will be a minus. Right, so what is the net effect? It's going to result in increase or decrease in profit. Right, you see here you have a decrease in profit, and then there you have an increase in profit. So you have decrease. All right, so decrease is in brackets. So you're saying no, a reduction in profit. I'm going to record it in brackets, and then you have an increase. All right, so an increase is not in bracket. In profit. Right, anyone who's lost so far? Right. So basically that's how we go about it. Then we move on to statement of financial position. So what is the effect on the statement of financial position? So we're going to have an increase in property, plant, and equipment. Right? Remember now, the value of our PPE item is going down, is going up. So how much is the increase in property, plant, and equipment? So we can agree now that we have 25,000, right, which is going to increase our PPE, right? But of course, less depreciation. So PPE is going to be 25,000 minus depreciation, which is 5,000. And then for 2010 is 25,000 minus depreciation of 2,500. So that's the increase in PPE that we have there, right? And then here we have 25,000 minus 2.5, which gives us 22,500. Now, what is the effect on taxation? Let's work out effect on deferred tax. Right. So in terms of this, let's quickly account for it to see what is the effect of deferred tax. So we have carrying amount. All right. And then we have tax base. Then we have temporary difference. Then we have deferred tax. Right, let's see now what's going on there. So we have property, plant, and equipment. All right, or you can just name the name of the property, plant, and equipment item that you have. So what is the carrying amount of your PPE item? So in 2011, all right? 2011, your PPE is sitting at 20,000, all right? Let's see what is the tax base. So SARS is granting you how much? All right. So in regards to this, the accountant immediately informed the SARS of the error, and the SARS agreed to reopen the 2010 assessment in order to correct this error. All right. So in terms of this, it means now, all right, in regards to this, your tax base. So this is for 2011. All right. So 2011 tax base is going to be sitting at how much? So you have 25,000 minus what? 25,000 times 40%. All right. Okay, we can just say plus 25,000 times 20%. Remember, you claimed allowance of 40% in year one, which is 2010, and 40%, 20% in 2011. All right. Alternatively, you can just say 25,000 times 40%, the remaining period is still fine. Right. So in regards to this, you have 25,000 times 40%. So that's what will be your tax base. Then your temporary difference will be the difference between these amounts. All right, so you have, of course, deferred tax liability. All right, so it's sitting in like that. So it means now in 2011, you're going to have increase in deferred tax of 2,800. All right, SARS agreed to reopen this. So you have increase in deferred tax. All right, liability. All right, so here you said, an increase in deferred tax liabilities, 2,800 there. All right, then, of course, in 2010, right? So property, plant, and equipment. All right, so what's going to be our carrying amount? So the carrying amount, we calculated at 22,500 there. All right, you did work it out here. All right, and then the tax base. So the tax base, remember here now, we have 25,000 minus. So you just claimed an allowance of 40% times 25,000. All right. So in regards to this, you have 25,000. So literally just saying 25,000 times 60%. All right. So that's your tax base. So tax base will be 15,000. All right. And then you have the difference between these two. And then, of course, 7,500 times 28%. So it gives you deferred tax liability of 2,100. So it's just sitting in with 2,100. Right. And then you net it off, assets minus liabilities. All right. That's what will give you increase in equity. So you have your increase in equity sitting in like that. So you have your increase in equity. Right. So the increase in equity is that. Then you have increase in opening balance, retained earnings balance. All right. So the balance increase in equity for the prior year becomes the increase in retained earnings balance for the current year. Right. So basically, that's how your change in accounting, sorry, your prior period error is accounted for. Questions, guys? All right, cool. So if you guys don't have questions, all right, I will see you next week. All right, and good luck to the guys who are writing on Monday. All right. See you guys next week, Thursday. Bye, guys.
Thanks, Ian. Bye.
Right?
Bye.
Yes, there's the topics similar, true. All right, small differences. All right, bye.